Thank you for joining us today for Revenue-Based Analytics. This is the third in our financial statement analytics series. We hope you have been enjoying the series and getting a lot of good information. If you've missed any of our previous webcasts, they were recorded and are available for viewing at automation.com as an on-demand video. A quick reminder before I pass you over to our speaker, Jeremy Clompton with BKD's Forensic and Valuation Services Division. This webcast is being recorded. It will be sent to you via email following the presentation. If you have any questions, please type them in the question box on the right side of your screen. We will answer them at the end of the presentation. I'm now going to turn it over to Jeremy so he can show us his top tips for revenue analytics. Thank you for sharing your expertise with us today.
All right, thanks, Lindsay. I appreciate it. And hello, everyone, and thanks again for joining us. Hopefully, you've been able to catch the first two webinars in this series where we focused on accruals and expenses. Today, as Lindsay said, we're going to be focusing on the revenue side of things. And as you probably can guess, a lot of what we're going to talk about is looking at revenue and how it is traditionally being just a little bit enhanced to help improve that bottom line or even the top line. Meet various targets. Maybe it's for commission purposes or whether it's meeting earnings expectations. But typically speaking, when we're talking about revenue, we're really talking about how can we increase that number and make revenue look better than it really actually is. So today what we're going to be doing is we're going to be hitting on 4 different items. 3 of them I'll have live demonstrations on. One I won't, but I do want to at least explain what it is and how to look for it. It's one that's very difficult unless you have a very specific example, and I don't actually have one that I can share. But I do want to at least explain that concept as well, because I think IDEA is a great tool to help look for this as this type of a transaction. But the first 3 that we're going to hit are fictitious revenue, premature revenue recognition, channel stuffing, and circular revenue transactions is what we'll wrap up with. And as we go through each of these, we'll kind of talk about what it is, why people may do this type of a scheme, and then also talk about some of the detection methods that we can use. As Lindsay mentioned, we'll definitely be taking questions at the end. I'm happy to answer as many questions as I can within the time that we have. We'll try to shoot for 20 minutes, may go a little bit long, but want to make sure we get as many questions answered as possible. So go ahead and type those in on the questions box on your GoToWebinar window. So let's go ahead and get started with fictitious revenue. And fictitious revenue is exactly what it sounds like. It's just completely fake, made-up revenue. It doesn't exist. Many times the customer doesn't exist, and it's really only there to hit sales targets and meet revenue expectations. And a lot of times it relates to somebody that's earning commissions. So if you have a salesperson that actually has some access to the customer file, they may be going in there and setting up a fake customer and go ahead and get them some invoices. That way it bumps up their sales numbers, and it's going to help get them those commissions and those bonuses that they're looking to earn. Now, a lot of the ways that we can find fictitious revenue of this nature is focused on the customer master file and customer-based metrics. So much like what you would do in the accounts payable for fictitious vendors, that's one of the best ways to start looking for fictitious revenue as well. Go to that customer file, compare it back to your employee file. Matches on name, address, tax ID numbers, phone numbers, any indication that it could actually be one of your employees, especially your salespeople, that's related to that customer and looking for those unusual transactions. The other thing to consider is, do you have a customer with a post office box where that's unusual for your organization, or maybe a mailbox service like a UPS store? You want to think about those things as you're going through the customer side. And then also on the customer's metrics side, especially where customers are similar, looking at their average sale, average price of goods, how often are they occurring, when are they occurring, and looking for any customers that have metrics that just don't make sense in the context of all the other customers of a similar nature. Maybe they only have sales or purchases from you right at the end of a quarter on only the quarters where you don't hit, where your sales aren't where they should be. Maybe that's one of their unusual patterns, or maybe they just have a ton of sales right in a flurry in the last 2 weeks of a quarter, and maybe 1 or 2 up until then. So you want to take a look at some of those metrics. But within the actual general ledger detail itself, as it relates directly in the financials, there are a couple things that we can do related to the invoice file, and that's looking for weekend invoices and unusual invoices. So maybe they're invoices dated on a holiday or in a around $1,000 increment. And we're going to jump into IDEA and actually take a look at that. So what I've got here in my invoice file is I just have a list of all invoices, the dates, the PO number, the vendor number, and some other information. Some of the things that I would always encourage you to look for here again are just those unusual invoice character. Invoice is an indication of a fictitious invoice. If your sales department is not open on the weekend, one of the very first things I'd recommend you do is look for items that are on that were issued on a weekend, because maybe somebody's coming in right at the end of the period and issuing some invoices. It's a remarkably quick search in IDEA. If we go to our criteria, we're going to go ahead and we're going to use the workday function. And what that workday function does is it's going to take a date, and for us there, and I'm actually going to do this in the actual itself. I apologize. I'm going to jump over to this. My sales order. I've got my revenue, my day. If that date is not on a working day. So in this case, the workday function, if you come over here, you can see that workday, if it's a 0, it's on a weekend. If it's a 1, it's during your. You can custom on a weekend. We'll go ahead and validate. And we can see all of the activity, and out of 86,000 line items, only 20 and there, and we can start to review those and say, do they make sense? Now, a couple things to keep in. We got quite. They may not be actual revenue entries. They may be reversals that occur right after a period end. And as you recall from our timing difference discussions in Excel and expenses and accruals, reversals right after a period end are very important, and we're going to talk about that actually in our next example. But paying attention to those debit entries, just the same as you would your credit entries, can be very important. The other type of thing we may look for here is looking for entries where it's in a round $1,000 increment. So what I'm going to use here is ISINI function, and I'm going to search for the string of 000.00, and I'm going to look within a text string of my BKD amount, which is what's in the credits, and I'm going to make sure that it has for those. We're going to see right off the bat here, even fewer, only we want to make sure that we don't have round $1,000 items hitting our revenue that don't make sense. So that's just a couple ways that we can look for the unusual types of entries or invoices. This works in the invoice file as well, as it relates to the revenue side of the house. The next thing, the next period, we want to consider that as well, because if we see this start to happen, that means it's going to have to continue and it's going to perpetuate itself throughout the year. So here what we're going to do is we're going to look for unusually large sales in the final week of the period or the final couple weeks of the period. And for this, I'm going to use a feature in IDEA that we haven't used a ton yet. What I'm going to do is I'm going to use the stratification I've talked about yet in this series, so I think it's a great example. And I'm going to do stratification. I'm going to stratify on my beacon, and I'm going to add a few different layers here. That's going to get us, it should encompass most of our revenue entries and our reversals then, just for an example. But I'm going to go ahead and hit OK and see this stratification. Total that same amount field, 5 almost % of our negative 20, track them out, we want right near the period end. If we go back in and let's look at that next little bucket there as well, again, highest revenue we have in numbers right at the quarter end. Great using is another one that is a little bit interesting, and channel stuffing is typically more of a frequency-based item. So you're looking at large volumes of sales versus large dollars of sales, but a lot of times you're going to see that those correlate pretty closely. And what we're going to do is we're going to see, do we have an increase in our volume of sales right before a period end? And then many times in channel stuffing, what they're doing is they're shipping out the goods to the suppliers, recording that as revenue, and then right after the period end, they've already told those suppliers, you know what, you can go ahead and send it back. If you don't sell it, that's fine by us. So they get the revenue, and then right after the period end, everything gets sent back, and it essentially gets reversed out. So we can look for large volume sales and corresponding returns. The other thing on channel stuffing that we want to think about relates to the invoice sequence. And the invoice sequence is a very important thing to look at, because where we start to kind of send a bunch of goods to a single place, we might have sequential invoices to the same customer. We might have some missing invoices where we're trying to hide some documentation. So we want to look for gaps, and we also want to look for sequence things. And we'll talk about both of those right now. So back in IDEA, I've got my revenue information here. I'm going to go ahead and clear my criteria. And what I'm going to look for here is I'm going to summarize on my date, and I'm going to look at my debits and my credits. So I'm just simply going to summarize on BKD date, subtotal my debits and my credits. I'll go ahead and pull across my BKD amount. I like to have that there as well. And I'm descending order, where are the majority of my entries, when are they taking place? And if I look up here, my top 4 are January 31st, June 29th, March 31st, and September 29th. The highest volume occurs on pretty well the last business day of the period, which would be an indication of the way we can get our numbers. And if we looked at the debits, we might see that we've got some high debit numbers. I'm not sure on this. But if we look at our debit numbers, corresponding reverse that day of over $150,000, which again would be a little bit unusual for us. So using that summarization just on the date and looking for frequency and number of records can be very important. Within the invoices file, we're going to do a couple different things. The first we can do is just the simple basic gap detection. And again, we're going to go off of invoice number here and hit OK. Right off of them, if we do on missing items, we've got over 7,700 NAP. We want to make sure they're accounted for. The other thing that we want to do is look for sequence items, and I'm going to walk through the building of this. So the first thing that we want to do is we're going to say, and at the same time, vendor number, and I'm going to see that I've got 2 items here. Now the problem is those invoice numbers aren't sequential and those vendor numbers aren't the same, but what we've done is only accounted for one side of the pair. So what I'm going to do is I'm going to go ahead and add some parentheses around all this and then select it and just simply say or equal the get value. Now I can look. The final item that I want to touch on today is, don't have a great example for this one. It's a very complex, but really what a circular revenue transaction knew at the time of an acquisition. So what happens is essentially if somebody is buying a company, and this can happen with other customers as well, what you can do is you can essentially pay the target. You send some money to your acquisition target, and then they're going to send you that money back on the exact same day as a purchase of goods or services. So what that looks like is essentially you have a parent company and their acquisition target, and they're going to buy the company and they're going to send them $5 million, and they're going to buy the company. But the problem is but what they need to do is they need revenue now. Take some of that money and they're going to send it back to the company that bought them and call that a sale, and they're going to record it as revenue. So essentially it's cash that's going to and from back to the company all on the same day, and it helps to enhance the revenue and that top line revenue number. And it's something you really need to be aware of in situations of acquisition, because that's where this is probably one of the highest risk areas for that. We've seen it outside of acquisitions, though it's much more limited. So with that, that's going to touch on our 4 main topics as it relates to revenue. As we talked about them, we're looking for fictitious revenues, channel stuffing, premature revenue recognition, and circular revenue transactions. A lot of the revenue-based frauds out there are there to enhance that revenue number, so we want to look for those unusual items. As we've talked about in accruals and expenses, timing differences are very important. Shouldn't be overlooked in revenue. I just haven't touched on them today because it's something we've talked about before. As somebody pointed out, I did mention, I think in my example just a second ago, it actually had vendor. That was supposed to be customer. The organization that file came from uses the terms interchangeably, so I apologize if there was any confusion there. I would invite you to join us for our next series. It'll take place here in just 2 weeks, and we're going to be taking a look at the financial statements as a whole. So looking back, big picture at the financial statements themselves, the disclosures, the notes, all of that information, and how we can use analytics to think about the financial statements a little bit differently as it relates to fraud. That'll take place on September 16th at 2 p.m. Central Time. I'm going to go ahead and take a few questions. So you have my information. It is up on the screen now. If you don't want to ask questions, through the questions bar, feel free to email me questions. I do try to share information on Twitter and LinkedIn and resources about analytics. The slides and the video recording will be distributed. I think Lindsay mentioned it may be a couple days, I think, before the video comes out. I don't recall the specific timing on that. I know that she'll mention it right here at the end of the webinar. the slides will accompany that information as well. Another question that I have here is, when looking for customers related to an employee, do you ever look for customers that have acronyms that match an employee's initials? And also, do you look about geospatial differences, so looking at the latitude and longitude and proximity-based analysis? And yes, I think those are both great tests as it relates to the customer file. When it comes to a fictitious customer, you're essentially the same testing that's applicable for a fictitious vendor can be very applicable for a fictitious customer. It depends on the scenario as to which one is more likely to occur, but a lot of the same tests apply. So when you're looking for relationships between customers and employees, the employee's initials, if you have family members' initials, a spouse or a child, that can be helpful as well. The proximity analysis, where if you have what appears to be a business entity customer located in a residential neighborhood, and it's located near one of your salespeople, that can be very important. So I think that those are both great tests and a great idea that was thrown out there from one of the attendees today. So thank you for that. Any other questions before we wrap up? And Lindsay, I'll turn it back over to you.
Thanks for sharing with us, Jeremy, and to, I guess, respond to the question about the slides and the video. Our goal is to get those sent out this week. We're going to try using the GoToMeeting emailing system, so it might come from GoToWebinar and not necessarily from an automation email account. But keep your eyes open. Our goal is to get that sent out this week. And yes, the slides and the video will be included. And if you are interested in joining us in 2 weeks, we are sort of listed as sold out, but we may be able to squeeze 1 or 2 people in. So if you're interested, just send me an email at marketing@automation.com. And I think that's all we got, Jeremy. I don't see any other questions popping up, so.
Sounds great. Well, Lindsay, thanks again for having me. I appreciate it.
Yeah,
And thanks
thank
everybody for
you.
attending.
Thank you for attending. Have a nice afternoon.